Okay, let's dive right into this. Welcome back to The Explainer. If you're a focused learner trying to maximize your mutual fund portfolio, the sheer noise of the financial markets can just be absolutely deafening. So today, we're going to cut right through all that noise and look at a very specific, totally data-driven concept, RSI. We're going to break down exactly what it is, and way more importantly, how you can use it to make smarter, more confident investment decisions. So, you might be wondering about one of the most common anxieties investors face. Can traders' tools actually work for mutual funds? We constantly hear stock traders throwing around technical jargon like RSI and kind of just assume it's strictly for day traders glued to like 6 monitors, right? But can a tool built for rapid-fire trading actually give long-term mutual fund investors an edge? Well, the short answer is yes, but only if you approach it with the right framework. Here is our roadmap for today. First, the market's thermometer. Second, decoding RSI levels. Third, real Nifty RSI examples. Fourth, mutual fund application. Fifth, your RSI action plan. And finally, the golden rule. Let's start with part 1, the market's thermometer, understanding the basics. So, what exactly is RSI? Well, it stands for Relative Strength Index. It's really just a momentum indicator that sits on a simple, fixed scale from 0 to 100. Its entire job is to reveal the current condition of the market, specifically whether the market is fundamentally overbought or oversold. It literally strips the emotion out of the equation and replaces it with pure, objective data. Think of RSI literally like a thermometer for the stock market. If that thermometer reads above 70, the market is too hot. It's running a fever. If the reading is below 30, the market is too cold. It's freezing. It really is that accessible. You definitely don't need a finance degree to read a thermometer, right? And you don't need one to understand what RSI is telling you about market sentiment either. Moving right along to part 2, decoding RSI levels, the 3 zones. This brilliantly maps out the market psychology into 3 distinct zones. When the RSI level is above 70, the market is overbought. Prices have surged, euphoria is super high, and the market might cool down soon. On the flip side, when the RSI is below 30, the market is oversold. Fear has completely taken over, assets are heavily discounted, and the market may be getting ready to bounce back. And that sweet spot right in the middle, between 30 and 70, that is the normal zone, just business as usual. All right, part 3, real Nifty RSI examples, history and action. Let's actually look at real market behavior to see how incredibly powerful this is. Cast your mind back to March 2020, the COVID crash. Panic was everywhere. But what did the data actually say? The Nifty RSI plummeted below 30. It flashed a massive oversold signal. For long-term investors, that was a screaming buying opportunity. And sure enough, we saw a massive, strong recovery over the next couple of years. Now, look at the opposite extreme, the 2021 bull market peak. Total euphoria. Everyone was buying. But the RSI crossed that 70 mark. It became heavily overbought. And exactly as the indicator warned, the market soon slowed down and corrected. It truly captures those extremes perfectly. Now for part 4, mutual fund application using indices. Now, here is where a lot of investors make a massive mistake. They try to find the RSI of their specific individual mutual fund. Please don't do that. Think of the broader index as the ocean current, the massive whale dictating the flow, and your individual fund as a tiny fish swimming within it. You have to apply the RSI to the index. For example, if you're investing in large cap funds, you look at the Nifty RSI to guide your allocation. If you're doing mid-cap funds, you monitor the mid-cap RSI. The index tells you the environment your money is swimming in. Which brings us to part 5, your RSI action plan, what to do. Let's turn all of this into a really practical game plan. When that index RSI drops below 30 into that freezing oversold zone, that is the time to be bold. You increase your SIP, or if you have extra cash laying around, you add a lump sum to capitalize on the fear. When the RSI flies above 70 into the overbought, feverish zone, you do the exact opposite. You exercise caution. Avoid throwing in large lump sums and maybe even consider some partial rebalancing. And when the RSI is just chilling between 30 and 70, just continue your normal SIP. Let compounding do the heavy lifting. Finally, part 6, the golden rule, the warning. 0. That is absolutely the exact number of times you should ever stop your SIP based on an RSI reading. 0. Never stop your SIP. I want to be incredibly clear about this.
RSI is a fantastic supporting tool to help you make allocation decisions, like knowing when to inject a lump sum during extreme market fear or when to be super cautious during wild euphoria. But it is never, ever a reason to execute a full exit. Why? Because markets can stay overbought for surprisingly long periods of time, and timing the exact top perfectly, that's virtually impossible.
So the absolutely crucial takeaway is this. RSI helps you understand market extremes, not predict exact timing. It's a really helpful guide, definitely not a crystal ball. Use it to inform your strategy, to check the market's current temperature, and to make smart, calculated moves at the margins. That is how a focused learner practices truly smart investing. Before we wrap up, please remember, this conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing. But I'll leave you with this question to ponder. Now that you know how to actually read the market's thermometer, will you let the next wave of market panic totally dictate your actions, or will you use the data to buy when others are fearful? Thank you so much for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.